What's up, everyone? Welcome back to the Mortgage Heroes Weekly Podcast. I'm Andy.
I'm Brian.
And I'm Will.
And today, the three of us are going to talk about the top 10 moves you need to make if you are going to be a home buyer in the summer of 2025. So we're going to go through the top 10 things that we know people are doing right now to successfully become a homeowner. And also, this is going to be in chapter format. For any of you watching this on YouTube, you can skip through any of the chapters of each of these sections to go right to the place where you find yourself right now. And as always, you can find one of us to help you along the way if you don't know what to do next. So,
that's right.
Guys, you ready?
We're ready, Andy. Thank you so much for coming up with this.
Yeah, we're going to go right into it today, guys. One of the things that I know that plagues most people when it comes to buying a house is their credit score.
Absolutely.
So that's the number one thing we're going to talk about today. So let's get into the importance of credit, what people should do if their credit is poor, and what are some good credit habits they need to keep up if they're already in a good credit situation.
Absolutely.
Yeah, so I think one of the things with credit is a lot of people shy away from wanting to even know where it's at. Most of the people you ask, they're not really in tune with what credit is. But nowadays is very accessible to be able to, check your score by going on to Credit Karma, your banking app and all that. But the biggest thing is just knowing the pulse of where your credit score is. And that starts by just checking it.
Exactly. You know what? Most people also don't know that you can run your credit one time for free. And it's actually at annualcreditreport.com. So and we could put that on there, annualcreditreport.com, and it'll give you a good detail information as to what your current scores are, what's currently in delinquency, what's being paid on time, et cetera. So it's going to give you a good information to start understanding, where your credit scores are at. Very important.
Now, I know sometimes when we run people's credit score, they go, oh my gosh, it's lower than I thought. And then you go, okay, well, let's look at the report. And there's things that are maybe they're errors or mistakes that were made, or maybe something that's been taken care of, but the credit bureau hasn't taken it off their credit report yet. Or maybe they also have a common name with someone else who might be, look, William Flores is a pretty common name. And so, if you find yourself in that situation, this is a good time to go and correct some of those things well before it's time for you to get into a loan approval and get into a home.
It's so true, Andy. A lot of times, we name our children after us. We're juniors. And so they almost inherit that credit history, which in a lot of times as a parent, if we're not paying our stuff on time, it does negatively impact that child.
Yeah. So let's talk really quickly about what are kind of like some of the rule of thumb for, let's say, credit ranges for people who want to qualify. So I want to start with what we do the most often, which is VA. Now, what would you recommend someone be in the range of credit score wise if they want to qualify for a VA loan?
Well, minimum, the lowest I would say is 640. 640 would be a good start. A great start would be 680, right, Brian? Mm-hmm. So anything below that, 640, is just challenging. The interest rate for that credit score is not going to be in your favor. So the better the credit score, the interest rate's going to be more favorable.
Yeah, to Will's point, I think it's important to understand that your credit is going to dictate your interest rate. So, even if you come in with the minimum threshold, that's not going to give you the lowest interest rate. So it's best to have, as high as possible. 680 is a great starting point to get, those better terms. Once you're in the 700, 740s, you're getting top of the top terms. But I think it's important to understand that, yeah, you can get in with the minimum, but you're also not going to get, the most favorable terms.
Yeah. So let's talk about FHA real quick too, because what does FHA need a borrower to be at these days? Is that also at that 620 mark? So or more like 640 to be better off, right?
FHA, I believe, is a little interesting. I've done one at 580, although I don't recommend that, you want to buy a house at that type of score. But again, FHA allows you to have more debt, have a lower threshold, but if you want to have the least road of resistance when applying for a mortgage, getting approved, minimal verification, or just questions about your application, you want to apply with a higher credit score. Again, the lower tier minimum entry is 580, but again, it's not guaranteed that you're going to get approved just because of that.
That's correct. As a matter of fact, today we just approved a client with a 547 credit score. It was a 660 purchase price with $400,000 down. So the max that allowed for their income was a loan amount of 260, and it was FHA was like 38 over 56% back end ratio
for debt to income.
Debt to income. So we want to always stay within 46.99% over 6% is what
So-
we're getting approvals.
In the case where maybe the credit score is really low, I know in the past there have been exceptions, right? There's certain other conditions that might come up if you have less than a 720 or less than a 680. So is that the case here too? A 547
Absolutely.
score, but it's got some other conditions?
Absolutely. So in this case, since we do work with several investors, we have to find that investor that has an appetite for that lower credit score from that 480 or below, like like Brian's.
480?
I'm sorry, 580.
The 580. I was like, whoa,
apologize. Yeah.
480. A four handle on the front. I don't know about that.
Yeah.
That's the first time I heard of that.
Another important thing to understand with low credit scores is the interest rate's going to be much higher than having good credit score. Therefore, because the interest rate is much higher, it takes away from your purchasing power. And for every 0.25%, that could be equate to a $10,000 to $30,000,
Difference.
loan amount in difference.
Wow.
Correct.
Yeah, that's a lot. That's pretty substantial.
Exactly.
I want to talk about conventional before we go talk about what people can do to increase their credit score. So where do you want people to be right now for conventional financing? As far as credit, what would you say the floor of that is?
I feel for me, if you're going to be using conventional financing, you want to be at a 680 at least, and that's going to give you the best rates for that exact program. Although you can get by with a 640 with certain banks, again, it's just going to be your appetite of how much you want to pay, if that rate is okay with you and that payment is okay with you. But if you have a higher credit score, it's always going to equate to a lower rate.
Yeah. And I know that, for many years, we've been in this a long time. So like 720 used to be thought of as like, oh, if you have a 720 or above, you're good. But that's changed in recent years. So are you guys finding it's more like everything above 740 is all treated the same? Is it 760 or 780? At what height of a credit score does everything else just kind of become the same?
760 and above.
760 and above?
760 and above.
Yeah.
So anything below that, and everything has to do with mortgage insurance. Most people that are going into the entry home, they're putting anywhere from 3 to 5% down. With conventional financing, you could go with 3% or 5%. I always say going with 5% because you get the better interest rate. You don't get that hit for the loan to value. And then in addition to that, the mortgage insurance, the monthly mortgage insurance is based on your credit scores, unlike FHA. FHA, it doesn't matter what credit score you have, you're going to get that 0.55 or 0.85 depending on the loan amount.
Yeah, for the mortgage insurance.
Correct.
Yeah.
Whereas
okay.
with conventional, it is in your favor. So if you have excellent credit scores, even though the interest rate is still going to be higher for conventional financing, the payment's going to outperform an FHA because it doesn't have the upfront mortgage insurance premium of the 1.75. In addition to that, you'll have a lower monthly mortgage insurance versus the FHA side.
So let's talk to people who may have their credit they might feel like it's in the ditch a little bit and they need to do a little bit of work. What are some of the most common things you see with people who have low credit scores and the advice you give them to help get their score up so that they can be in that qualifiable range for VA, FHA, and conventional financing?
Well, there's different scenarios.
Yeah, like I was gonna say, I mean, it depends. If you have high debt, I'd advise go towards the highest interest one first, pay that one down. But if you can bring your debts under 30% utilization, William taught me this trick when I got started in the industry. You're basically able to then bring your scores down. And anytime you start going above the 30% threshold, your scores start to decrease. So knowing that information, if you can play within the 30% the utilization of your credit, it's going to give your scores a higher boost when you're applying for a mortgage. So at the time that you're applying for a mortgage, make sure all your credit cards are either paid down to 30% or below that to ensure that you get, the best terms.
And I know connected to that is the payment history. So, payment history is, I think, obviously, I would like to think it's obvious to everyone that's a really important component, but sometimes we go, oh, it's okay. It's just my, my little, line of credit payment here for, my store credit card or something like that. It might seem like it's super innocent, but late payments actually really hurt you a lot. Payment history is the largest weighted factor of your credit score, next to balance of credit used.
Credit utilization.
Those two things together, I know in the past it's been around this, but it's about 60 to 65% of your score's weight is just those two factors, whether you're paying on time and how much your balance that you're using, your utilization.
And to Brian's point, he's absolutely correct. It's 30%. But what we gotta remember is the most important ones are revolving credit. Revolving credit is everything. That means like credit cards. The most important, have the greatest impact. And the reason for that is, unlike an installment loan, like a vehicle, a student loan, or just, a regular personal loan. With the credit card, no matter you paying off the actual full balance, the credit bureaus will still give you credit history based on that. And that's where the utilization comes in. Whereas with an installment loan, if you pay that balance off, it actually affects your credit in a negative way because you paid that loan off and therefore there's no more history to rate you on. So that's paid off. It's not like a credit card where it continues to rate you. You know, you didn't use that. That's not a necessary bad thing.
Well, and that's an important point too, is if you do pay something off, you don't need to close the account. You know, it's good that you're paying something off as far as like maybe your score, but you know, if you close that card and it has maybe 5 years of lifespan, you're chopping off 5 years of good reporting credit history that could be aiding you in your score.
That's a great point. Exactly. Do not close credit cards. If you do plan to pay them off, the best suggestion is just keep it open and let the creditor close that account for you.
Yeah, shred the card.
Yeah, shred the card.
Shred the card. Forget the number.
Well, it sounds like if you, the consumer, closes the card, you get a hit. But if you stop using it after you pay down the balance, wait some time, the creditor themselves have the option of closing that account, in which at that moment you don't get a hit on your credit.
Exactly.
Yeah, that's
and
smart.
it'll probably hit you, but like, you know, a lot of times we pay it off and we close it off.
Yeah.
So now you close off that history by just closing it off, right?
Yeah.
So paying things off a lot of times actually hurts you in a negative way, you know, and it takes time for the credit bureaus to actually understand your algorithm, how you're paying. Is this person always getting in debt or not? Oh, he paid off all his debt and he just closed it. That's kind of like a double whammy.
So one of the examples that comes to mind is I've had clients where they're, you know, in the process of getting approved and they're like, yeah, and I'm about to pay my car off. I'm like, whoa, 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 whoa. So if you're in the process of buying and you want to pay your car off so that you can improve more, it's a double-edged sword because you're going to take a hit on your credit. Although your debt to income ratio is going to take a little bit more, make sure that you don't, ding your credit, and then that hurts you in the process.
That's more definitely of a strategy and tactical approach, because on one hand, if the car payment's hurting you and you need to get the car payment off of you to qualify, that's one thing. But if you're using the positive credit history and it's healthy in your favor for your score, that's another. So you might be in a little situation there.
I like that. And so, to your point, Brian, I had a client that in order to qualify, I had to have them pay off their vehicle of $27,000, and they have like $350,000 that they can play with. She's like, "Let me pay this off," and I'm like, "There's no need. Wait until you find that home, and then we can figure that out."
Smart.
Right.
And so, take your time. Fast forward a year and a half, she hasn't found a home yet.
So that's so important because, when we have the conversation with clients, like, yeah, I could go pay it off right now. And I'm like, no. Yeah. Because to the point, you don't want to just pay it off if you don't need to right now. Though it needs to get paid, you don't want to, jump the gun.
The way I look at good credit, guys, is like a healthy branch on a fruit tree. Like, as long as that branch is healthy and it's providing good fruit for you, leave it there.
Yeah.
So wise, Andy.
And, one of the other things, don't rely always on Credit Karma and those credit companies, okay? You got to remember there's such a thing as consumer credit when you're applying for credit cards, right? And then there's going to be, even when you apply for a vehicle loan, is very distinctive than a consumer credit. And then with mortgages, we're going to really, because it's going to be one of the biggest debts of the consumer's lives, we really have to nitpick everything.
Yeah.
So it's very thorough and it's going to be very different. There's times where we run the credit, the client will tell us, well, on Credit Karma is 640. And I run it, it's like a 7-something.
Yeah.
Well, why is there so different? It's really hard to explain because I don't know exactly what's utilized for consumer credit. And then I've also seen the reverse effect on that, where Credit Karma will be like 780. I run the credits like 680.
Yeah. And it also goes to the point of there might be errors on one credit bureau that there isn't on another. And, again, whether it's the name thing or if it's the way that the specific creditor has reported the activity on your account, sometimes the credit bureaus have errors on the, actually, sometimes I'm giving them a free pass saying sometimes. Oftentimes you'll find that there is an error happening at one bureau or two, and it's not happening all three of them. And you can clean that up, and then your scores will look a little bit more equal. They do not use the exact same scoring model. So if you see 3 different credit scores on your tri-merge credit report, that's normal, but it's not normal if you have a 780, a 777, and a 580. There's something going on there. If you see a huge disparity, that's when you need to ask some questions, do a little more of a deep dive, and find out what may be going on.
Yeah, that's great. One of the most common questions that we have: are you going to pull my credit? Are you going to do a hard inquiry? We do hard inquiries. In order for us to provide it what's called with an AUS approval, we have to run a hard inquiry, really analyzing the full credit. And a lot of people are concerned about that. And I tell them our thing is it's better for you to know what you have now and what we can fix if needed. Or if you have excellent credit score, there's nothing really to worry about.
Yeah.
At the same time, maybe there's a card right there that you didn't realize you had such a balance. And now I can really, update you on that.
Yeah.
Although a lot of times the credit bureaus take anywhere from 45 to 60 days to update the information, it can be when we run it, it can be that they've already made a payment. It's not reflected yet.
Yeah, really.
So it just gives you better insight.
Really great point you're making about the timing of that too, because let's say you're trying to buy a house in the next 60 days. Well, if you do find something that's erroneous on your credit report or something you need to address, whether it's in the utilization or it's the score itself, it's the like name and someone else's credit, whatever it is, it may take longer than 30, 60, or 90 days, depending on the bureau and the problem and what kind of evidence you have to submit in order to get it taken off or cleared or whatever. So don't paint yourself in a corner by waiting to the last minute to address these things. Be proactive and do this months ahead of time so that way you can get qualified a little
Absolutely.
easier.
And the credit companies that we've been running credit, they actually have simulators now where we can pay a small amount of fee to tell them what's the potential increase in their credit scores, and it breaks down. Usually, it's always breaking down paying down credit card debt in order to achieve that goal.
Yeah. Awesome. Well, that was a great segment on credit, guys. I want to go right over to the next one, which is setting a realistic budget. And yeah, this is also coming before you even come into a mortgage application, because it's important to be realistic with what you're able to pay now. It's great that in your heart and your mind, you want to be a homeowner and you want to buy a place. But when it really comes down to it, whether you can afford it or not, and whether you're actually comfortable with it or not, really comes down to setting yourself a budget. Like knowing what your monthly expenses are, knowing what your savings are, having savings. If you don't, get some padding done, get some down payment saved, but really be meticulous about your budget. Know where you're spending your money, know where your money is going, because if you don't manage it, it's going to manage you.
So important.
Yeah.
So let's talk about that when it comes to creating. What are some tactics you guys have for sharing with people how to create a budget and what type of budgeting things they should consider before they apply for their mortgage?
One of the things that you get approved for is on your gross income. So, really understanding that what you bring in net is what you're actually going to be paying on. So although you get approved for, let's say, a lot more with your gross income, you really have to determine, what the actual income that's coming in, and then plan around that, because I've seen plenty of times where people get approved for a really high amount and they can pay it on paper, but when you really put it down and you look at their debts, they're paying $600 in car payments, a combined total of maybe like $500 in credit cards. It starts to add up and it's going to chip away at their debt to income ratio. So I think just knowing what you can actually play based off your raw income is going to give you the best clarity.
Okay.
Yeah, that's a good point, because we're going to approve you if you're making $200,000 a year gross. That's what we're going to use to qualify you, which is very, very different than what you actually take home. The other thing that we don't account for in loan applications is, let's say you have a great nonprofit that you actually provide, monthly you contributions, or you go to church and you give that 10% tithe. We don't know who you are, but there's a lot of you that do that, and that's one of the questions we don't ask on the loan application. So consider and factor that in as well. The other thing is cell phones. We don't account for cell phone bills. We don't account for Hulu, HBO apps, and all that stuff.
Those things add up.
Exactly.
Utility bills and all that stuff.
So those don't factor in. So you really have to consider that. And right now, with interest rates the way they are, plus the home prices, it's really getting, people where their affordability is very, very difficult. And it's difficult, not just here in San Diego, it's in the nation. Yeah. So those are really things to consider. Is the payment that it used to be for me, like I say, I wouldn't be able to make a $7,000 payment right now, because I've been so used to making a $300 to $3,500 monthly payment. And to see these new payments is just, you got to be better prepared for that.
Yeah. Something I know in the past, I was telling people is if you're getting yourself ready to buy a house, is look at what your current rent payment is. Look, after all your expenses every single month, how much money do you have left? Because if it really push came to shove, whatever you're paying for rent and however much you have left over is what you could, quote unquote, afford in theory. Now, I'm also saying that you should be saving some money, investing some money, whether it's your 401k, you're doing IRA, you're just putting it in the bank, whatever you're doing, that should be part of your budget as well. So my general rule of thumb with people is hey, take whatever you're paying for rent now. That's $3,000. Okay, you have $1,000 left at the end of the month. Cool, $4,000. That means your comfort level of if push comes to shove, you could spend $4,000 a month. Now, the recommendation would be if you have enough of a timeline and an on-ramp for 3 months of that and 6 months of that, well, see what kinds of things transpire in your life over 3 months and 6 months, and does your budget still fit? At the end of that, do you have $6,000 extra dollars after 6 months? Then that means that $4,000 every month is still adequate for you. You need new tires for the car. The brakes got to get fixed. Emergency hospital bill, like, whatever it is that might be coming up, you have to account for, because those things are still going to happen when you own a house. It's not just happening because you're renting.
You got to have a war chest, and it used to be that you have to have at least 3 months to be able to live off in case you lost a job. Now it's increased to 6 months. You want to have that in there because it's taking longer for people to really find that job. Things are different.
Well, and there's things that come along with owning a house that, your rent it's baked into your rent. Maintenance costs, some utilities, depending on what kind of building you're living in or what community, even the trash bill. That might be included in your rent. Those things are not included in your residence. Depending on, again, condo, townhome, single family house. So some of those things that might be tucked into your rent payment may or may not be part of your housing payment when it comes to qualification. And you got to remember some of those things.
No, absolutely. A lot of times, we get approved and we're looking for these homes and we see this home. We're like, we love this. And it could be $20,000, $30,000 above what you've been approved for. But this is where you see yourself, which is great. It's great to see yourself, visualize yourself and say, hey, this is where I'm going to create all the memories with my family, etc. But at the same time, you got to pay attention to those numbers. You got to pay attention to what you're going to sacrifice in order to be there.
Yeah.
And everything does come out of sacrifice. The great thing is rates will go down. So at least we can count that you're going to be refinancing with time. And the cool thing about that is if you strategically plan yourself, it's like you can feels like you're skipping 2 months payments. Even though there's no such thing as a free lunch, everything's paid for in your closing costs, you're not skipping anything. But because we pay our mortgage payment in arrears, it seems like we're skipping 2 months payments.
Right.
But at the same time, it does allow for people to save up, at least mentally think, I am skipping, I'm going to put this money aside. And that helps you build that war chest.
Yeah. Well, if you find yourself in a position where you're not sure what your monthly budget needs to look like, or you don't have a monthly mortgage calculator to identify a payment 1, payment 2, payment 3, we actually have one that we'd be happy to send you if you wanted to see what different mortgage payments look like, to then compare it to where your current budget is and then what it might be given the price and what you're looking for as the type of home and that kind of thing.
Exactly.
So,
and you know what? A lot of these mortgage calculators that are online, it's just telling you principal and interest. Add the HOA in there, add the property tax, and make sure that in your area, you're not just really Googling, you're like ChatGPT, and you're trying to figure out with the county assessors in that area. You could log in ChatGPT, a county assessors in Arlington, Tennessee, right? And it'll tell you descriptively what that property tax is, so you can implement that into that calculation. I just go with, I see here that it's only 0.5%, and once you identify that property, it's more like 0.8% or 0.1 some percent. It makes a difference.
Yeah. Well, guys, I want to move on to the next thing because there is a big difference between pre-qualification and a pre-approval. And I know that at this point, I would like to think that most people have seen a difference or been on the internet. They've seen someone else talk about there being a difference. So let's just really quickly define the difference. And let's talk about the advantage of getting pre-approved versus just getting pre-qualified. So tell everyone, what is the difference between being pre-approved and getting pre-qualified?
So pre-qualified is like, Andy, where do you work at?
Here.
How much money do you make?
This much.
What's your credit score?
That number.
How much money you have in your bank?
That amount.
Cool. You're pre-qualified based on that information, Tony.
And there's your letter.
There's your letter, yeah.
And it'll basically say, based on the information that we discussed, you're pre-approved subject to verifying that information through documentation.
Well, pre-qualified.
Pre-qualified. You're pre-qualified.
Yeah.
Approval is basically actually doing that extra step, verifying your documents, reading over your income, running your credit, knowing what your assets are looking like, thoroughly running them through a desktop underwriting approval system, and then that's spitting out a response based on your application. That desktop underwriter, desktop underwriter approval is like a golden ticket to these banks. As soon as they see that you have approved eligible, you're now able to submit the loan to get financing.
Can I tell you guys my quick little personal analogy here?
Yeah, please.
This is like if I have a friend named Thomas. He's a personal trainer. Like if I just call Thomas and talk to him on the phone, he can ask me some questions. But then if he's like, hey, show up at the gym tomorrow, bring your bag, and get ready to lift some weights, and we're gonna do like the little the little pinchers and all that. Like, now we're really putting numbers on paper now. Oh, okay, we're really actually making a plan. Oh, we're really getting like measured here. That would be my example of a difference. It's one thing to talk to a health coach on the phone or a personal fitness trainer. It's another thing to show up
Show up
and
to
let them see all the stuff that you need to be working on.
That's so true. That's
Very
so true.
true. Very, very true. You know, the most common thing what people don't know is most loans fall out because the loan officer did not verify the income properly. They didn't verify the income, so they utilized whatever they thought it was. And then next thing you know, that person actually doesn't earn that much. You know, and so now you have an escrow fallout. So very, very important to actually take a look at that income and really see, obtain, you know, either the taxes if they're self-employed or just the W-2s if they're W-2 wage earners, you know, and so you really need to just verify that information up front.
Yeah. One of the things I was going to make sure I share with everyone today is that you remember, if you're out trying to buy a house this summer or even in the fall or whenever it is, you're in the arena with people that have done this. So don't just think like you're the only one vying for that house on the corner that you love and you're the strongest candidate. Maybe you will be, but remember that there's other people out there looking for homes too. And if they've gone through the approval process and they have an AUS or DU, desktop underwriting approval, the bank is going to accept that as an approval. And the seller is going to likely ask for that as part of what they want to see with your offer. And in some cases, that seller might already have their lender try to cross-qualify you, which means you putting in all this effort to do the approval process versus just getting qualified is actually going to be more beneficial for you in the long run.
That's a great point. I mean, we started implementing providing the AUS for many years. It's really not supposed to be something that you provide a seller. The great thing about it, it shows transparency. It shows that things have been verified. Even though that is still manually inputted by a loan officer or a loan officer assistant, et cetera, you know, we still have to verify the information. These systems are so smart that it'll go into your bank. It'll verify what you actually have in there, the bank account. It'll verify your employment through the work number, which is a third-party service, or other forms of other third parties. So these systems are already integrated with that. Yeah. So if the borrower already says, yep, I allow you to do this, I give you authorization, then that stuff can be verified through the system already. These things are getting smarter.
And to your point, if the system rejects the application, a lot of times you're able to figure out what it is that it doesn't like or dislikes that you need to shore up or make more strong so that it will become an accept later, whether later is tomorrow, the next day, or weeks down the road, depending on what issue you have to figure out.
Exactly. And it allows you to do that up front versus waiting at the last minute and just getting pre-approved. And then now I'm in escrow and now it's going to fall out after incurred cost of an appraisal, a home inspection, and my time. And I already visualized myself in that property. I already loved it. And now I can't get in because I don't qualify. So that's why you do these up front to make sure that you get approved. Again, going to the transparency of providing this AUS, automated underwriter system, is so that most sellers are requesting to view it now. And the great thing about that, it does not show a credit. It does not show, social security number, date of birth, account number, or addresses. So there's really no way for anybody to steal an identity. It does have your full name because that's how we ran it, but that's about it.
Yeah. Yeah. What, you were going to say something, Brian?
No, I was just going to say, to Will's point, it just, proves that, you'd rather not shoot yourself in the foot and go and do the process, find the house, and then you didn't get approved, and oh my God, you're sad and not discouraged. It's like, do yourself the service and get approved, know exactly what it's looking like, and then go shop with the confidence, knowing that your offer could potentially be accepted because you're buying within the range.
Yeah, we're not living in an environment where winging it is going to work out. I mean, you'd be one lucky dog if that does work out, but I don't see winging it working out for a lot of people. It's the preparation and the fortune. What did I say? The fortune favors the prepared, right? And then the last thing I just wanted to tell everybody is, this is where your organization personally is going to be your best friend. This is when you have your hands on your tax returns. You keep adequate records of your pay stubs. You have your bank statements accessible. All the things that are going to support this process are to aid and help you. The loan officer is not trying to dig into all your back life because they have some personal care about that. It's about helping you cross the finish line and getting keys in your hands.
No, I'm glad you brought that to point because a lot of what we're seeing right now is we're seeing borrowers cannot qualify on their own. So they're asking the parents to, help them co-sign with them. And we're getting a lot of that. And a lot of these parents are actually receiving Social Security. They're receiving retirement. Well, guess what? We need the 1099s for Social Security for the last 2 years. And they don't know. They're like, well, we don't get them. A lot of times it's the mail. So I'm going to send my dad or my mom to Social Security. And I tell them, no, go to the Social Security and create a link. And it's always good for them to have that link, because there you can actually print out the last 2 years W-2s and your award letter for the upcoming year of what you're going to earn. And like, employment income, we're able to utilize the gross income of that Social Security, not after they take for medical purpose or what have you, deductions. We take the full gross income. So always good. If you get paid through, online, and you can have access to your pay stubs online, just get your access code and your password and just stow them away somewhere where you can find them.
Awesome.
And they're accessible.
That's good.
I always recommend that.
That's good. So guys, the fourth thing here on our list is to save for a down payment and closing costs. Now, some people get caught up with tricky language of marketing, like no down payment or low to no closing costs. And there's reasons that is done. And there's ways to make that happen, but it really comes down to the negotiation of the deal. What I would hope to do first here is let's just talk about some of the basics as far as saving for a down payment and closing costs. What are the general rules of thumb? Let's talk about what we do most, which is VA, and how we're helping people right now utilize their VA eligibility to buy a house with 0% down, and in some cases get their closing costs partially or all covered.
So I actually had a VA consultation right now before we jumped into the podcast, and he's a young veteran. He's 23 years old, just left the Marines 2 years ago, and he's actually looking to purchase his first house. I actually met him at a networking event last week, and his goal right now is to do a house hack. His wife works, he works as well, and then they have a little baby. Their goal is to basically utilize their VA loan, buy a house, and then, leverage the rooms inside the property to either, rent them out and, cover their rent. I think that's one of the smartest ways right now, if you're in the VA, if you have a VA loan, to be able to leverage it to, have your house, leverage the payment and be able to, live comfortably while somebody else is paying into your mortgage. A lot of people feel that it's very undoable, but it really just, takes a little bit of work, getting prepared, and actually, making the decision and moving forward. And I think the younger generation, that is in the military is more inclined to wanting to do this house hacking strategy. And it's shown that it works out if you execute it well.
Yeah. And I know that some people get caught up on what the county loan limits used to be, and now that's not a thing anymore. So let's talk about how people are using that VA eligibility to get 100% financing when they do their home purchase.
Well, yeah, as of 2020, they removed the county loan limit requirement. It used to be, and I remember seeing it for years, 2004, 5, no, I'm sorry, like 5-ish when we were getting in, it was like 316,000. Then it kept kind of creeping up and it stayed at 417,000 for a few years.
For like a decade.
It seemed forever, right? And so then not until 2020, they actually removed the county loan limit. So you can go up to 3-4 million as long as you qualify for it with no money down. And what we mean with no money down, it means no money towards your down payment. That doesn't mean closing costs. A lot of times we have that misunderstanding where we feel, well, it says no money down, but there's closing costs. Yeah, everybody pays closing costs. It's not like we're going to discriminate just because you're a veteran. FHA and conventional people have to pay and you don't. There's not a great benefit like that. I wish there was, but there isn't. So there is closing costs, and depending on who you're working with, is going to negotiate these closing costs. Obviously, every 3 months, it seems like the real estate market is actually going through different changes. And so before, when there was a limited supply of homes, very difficult to obtain closing cost credits. Whereas now that we're starting to see more inventory, simple economics, supply and demand, we're seeing that sellers are more prone to assist buyers with closing cost credit. For instance, we just got an offer accepted in the Murrieta area for $870,000 with $20,000 towards closing cost.
Wow.
And those closing costs could be towards actually your closing cost paying title, escrow, processing, you got your property taxes, you got prorated
your
interest,
impounds,
you got county recorder. So you have all these fees there. So you can utilize that. Or in this case, they give us options to do what's called a 2-1 buy down. Okay. Again, this doesn't require a down payment, so you can apply those towards closing cost.
So that sounds like it's just around, I'm doing the math over here. It's just about 2.5% of the purchase price, the 20,000 compared to the 870. Check my math if you want to be specific. It's about there. That's not important. The important part is that's kind of the same range that we advise people to be ready to have for closing costs. 2 to 3% in some cases, 3 and 4% in others, depending on what the deal looks like, where it is, what other third-party fees are associated with your closing. So general rule of thumb is you want to have at least 2 to 3% saved, 2 to 3% of the purchase price saved towards closing costs. It's a great benefit when the seller will come to the table and give you some of that as a compensation, but don't expect it. If you happen to get it, guess what? You still got your 2 to 3% saved up for yourself for whatever you want to do. But if they don't offer it, well, you're going to need that money.
That's correct. So yeah, the 2 to 3% would be in places you're going to say like San Diego. Everything's different. If you go to Tennessee, Virginia, where the sales prices are lower, you're going to need higher than that.
Yeah.
Because the processing fee, the underwriting fee, the title, the escrow, it's not like it's much cheaper.
Right. They're fixed costs, but because of the price of the house, it looks like a greater percentage.
Exactly.
Yeah.
So therefore, it's going to be a little higher. And then you're considering impounds. Remember, Texas has taxes right now in some areas. They're like 3.5% in some areas.
Right.
Pennsylvania also, they're like in the 2 to 3.5%. And there in Pennsylvania, we just took down a property where it was 670, but the property transfer tax alone was $36,000.
That's right.
So that's more than your 3 to 4% range.
So, and that was part of the closing.
Rule of thumb is based on the state where you're in, and always good to know what state you're in so you could understand how that applies.
Yeah.
Because that rule won't apply in every state.
Yeah.
Okay? Very, very different. Going back to the down payment, one of the things we're seeing, Andy, that is very difficult, and I'm sure Brian would agree here, is a lot of our clients don't have down payment, and they're asking their parents, or they're asking, there's companies that are willing to give you a down payment assistance because you work part of this company, you've been there for so long, so they'll give you some sort of type of grant. And there is also for like conventional FHA, some grants and some down payment assistance programs. Yeah. Now, people don't understand this, that everything comes with a catch. Okay. Whereas with FHA regularly, your debt to incomes, you can kind of push those a little further, but you're coming in with your own down payment. And therefore your interest rate's going to be a lot more favorable. Okay. When you're coming up with the down payment assistance, your debt to income ratios are a little stricter than if you came up with your own funds. In addition to that, the interest rate is much higher because they're giving you the down payment. And when it comes to lending is all about risk. So the less money you're putting out of pocket as a consumer, it's the less skin in the game. Therefore, we're going to penalize you by giving you a higher interest rate. And so those are the things that we have to kind of see where the pros and cons are and see if the cons will outweigh the pros in this case.
So, go ahead. Do you have
No, I was just going to follow up to that. Yeah, these first-time home buyer programs, they advertise no money down, but that doesn't mean no money out of pocket. And, if you're going to be using one of these programs, I believe the best, situation to use it in is when you have some sort of funds, like for your down payment, and you can get away with having that, your closing costs, but get away with being able to pay your down payment through one of these programs. Because what I've realized is that these programs also charge borrower-paid commissions on the lending side. So even if you're getting some credit for the closing costs, usually that's getting absorbed just to pay off your lender fees. So you're still going to have to come out of pocket with your regular closing costs, even though they advertise, you get a 2% loan for your closing costs at the end on top of your minimum down payment. That's only covering basically your loan costs and at times, your down payment, but it won't always cover your full down payment amounts. And that's when you have to get a little bit more savvy. If your agent that you're working with knows you're buying a down payment assistance program, maybe have them chip in a little bit or ask for a little bit more in the negotiations to be able to fully cover that whole amount and not just get in with the minimum, and then you still have to come in with some amount, and then that might be the deal breaker.
Yeah. So this is a good point to remind people, like, be aware what type of loan program you're going to be qualified for, or that you are qualified for, or what the requirements are. FHA is going to have a 3.5% down payment requirement. Conventional is going to be as low as 3%, but what's better for you is maybe getting to 5%. It's going to reduce your mortgage insurance. So there's some nuances to each of these situations that it's important to know that what the down payment requirements requirements are or aren't, and then what the closing costs associated with that will be based on your location, price of home, and all those third-party services.
And that's correct. For the conventional financing, you got to go to 3%, but then your mortgage insurance, because everything's with thresholds, with everything's in scales, right? Like loan to value, 97% is, there's less risk. There's only 3% risk that you put skin in the game. So then if you go down to a 95%, meaning that you're putting 5% down, you'll see that the interest rate's a lot more in your favor, and the mortgage insurance.
Yeah.
So a lot of times that 2% will make a bigger difference.
Yeah, it can make more of a proportionate in what am I trying to say? It'll make it proportionately better for you, not just incrementally.
And give you a better affordability.
Yeah,
So
absolutely.
if you're looking at, say you're just stuck at that $700,000 purchase price, but because you're putting 5% down, you may be taking that a little higher now.
Yeah.
Because the
Exponentially
interest rate-
beneficial.
yeah.
That's what I was trying to say. I was
There
like,
you
what's the
go.
word I was going to say? Exponentially beneficial.
Aha.
All right. Okay, guys. Next thing is researching loan options. Now, we've been talking a lot about VA versus FHA versus conventional. We haven't mentioned USDA loans yet, mostly because we don't have a lot of rural in our just general vicinity. There is some on the perimeter here of San Diego where people are moving to and looking for. But I just wanted to talk about, the idea that not all mortgages are created equal. In some cases, maybe the one you qualify for is the only one you qualify for, but there might be a case where conventional is better than FHA, or FHA is better than conventional based on the deal. So I want to talk about loan options really, really briefly. What's some of the things that are kind of most prominent when people are talking to you right now, whether they should do option A, option B? What do you find yourself talking to people about most often?
Here's the thing, and I'll take this one first. Here's the thing. It just really depends. Obviously, Mortgage Heroes is known to do a lot of VA because we like VA. And one of the sayings is what you focus on expands, right? So although we're able to do VA, we're very diverse when it comes to it. We're brokers. We're approved with over 150 lenders. We're one of the biggest brokers there is in the nation. We're in the top 5. And I'm proud to say that. In addition to that, we offer FHA, conventional, 203K rehab loans. We offer fix and flips, construction for non-owners, foreign investors. So the list goes on. And the reason for that is because we're so near the border and we're approved in 47 states. We want to be diverse. We want to be able to offer more products. So we're kind of like not your In-N-Out burger where you just have a select menu. We're going to be more like your McDonald's where we have a variance of a lot of choices, right? But we want to be able to be there so that we can provide the best financing option tool for that client. Okay. So we get a lot of foreign nationals that come over here. They just don't have a credit score. We have to find, where to go with this. But here in San Diego, we do a lot of VA, no money down. And we just try to figure out what's going to be the best options with that. When it comes to conventional FHA, some people come and say, well, I want an FHA loan because all they hear is first-time homebuyer programs, down payment assistance, not realizing that conventional offers the same. Okay. So once we identify that they're able and capable of putting more than just your 3.5% down, we may and their credit scores come up at a 740, we automatically think you may not be best suited for an FHA, even though the interest rate's going to be lower. But why don't we save you on that 1.75 upfront mortgage insurance? And why don't we lower your mortgage insurance premium from that 0.85 or 0.55% down to a 0.21 or 0.28% with 5% down? Makes a bigger difference in your payment. Therefore, it lowers it. And it just looks a lot better than your FHA.
Can I point something out real quick about
Absolutely.
that? I think there's a misconception sometimes that FHA is only for first-time home buyers, and it's not. That's the first thing. The second thing is if you are a first-time home buyer and you qualify, if you are maybe buying a house for the second or third time, you can still use FHA. And there are cases where you're a first-time home buyer and it can just be conventional. You just jump right to it. You don't have to make a pit stop at FHA Road if you qualify better than that in the conventional space. So don't feel cornered into that. Like you have to use FHA for first-time home buyer. And remember, FHA is not just for first-time home buyers. You could use it if you're buying your second house. Not a second home, not a vacation home or investment. But if this is your second purchase or third purchase and you're moving to it as your primary residence, you can still use FHA. And if your credit is below the threshold for conventional, FHA is what you're going to get anyways.
Well, you know what? I'm sorry. Let me clarify that.
Yeah.
Actually, Andy, if you owned a home here in San Diego and your job transfers you, say, to Washington, you can purchase again with FHA.
Yes.
100
You
mile
know,
rule.
as
Yeah.
long as you're over 100-mile radius from that other property that shows that your intention is to occupy that and your job transferred you that, not a problem. We can go ahead and give you another FHA.
Yeah. Sorry. Yeah. So same thing with VA. I know there's some situations where if you get permanent change of station, so PCS somewhere else, and you are already occupying the one here, but you're going to another place that you will also be occupying, then you can technically have two, but that is definitely an exception, not the rule.
Correct. Correct. And it happens quite a bit.
Yeah.
One of the things I was going to say was like, one of the things I've experienced more recently is that when I'm speaking to buyers, they're actually a little bit more aware of like the different programs. And I believe it's honestly because of ChatGPT or Google and just the mass information that's out there nowadays. But one of the things that I still, that I still see is that, they can only get so much information and then have to verify it with somebody to see what's true. How does that make sense? How does that connect? What does that mean? But I feel that nowadays you have so much more resources to search up the programs or the options. Then you just need somebody to actually tell you, okay, well, based on your situation, this is the program. But that initial search for a certain type of product, they can have an idea of what they want. They already found that, but then they just need to find the person that's going to help them bring it to life. And that's what I've been experiencing with certain buyers, that they're already have an idea of what they want, but they don't really know the whole picture and how to put it together. But they know that there's certain types of programs out there, and it's not all of them, but I do see a lot more people having a little bit more knowledge when they're getting approved or talking about mortgages.
No, absolutely. And one of the other things we're starting to see more that's coming up nowadays is actually going to be ARMs. Adjustable rate mortgages. I just had one of our biggest investors, and I was like, hey, we have 5-year ARMs. They were very popular back in the day, but because again, the mortgage meltdown, what we experienced in 2008, a lot of people shy away from the adjustable rate mortgages. They're like, nope, I don't want to be caught up like that same thing that was. We got to remember, back in that day, it was your interest rate was really 4.5%, but they gave you the option to pay 1%, the negative. And guess what people chose the most?
Yeah, the lowest payment. Yeah,
exactly. Because, but you have 4 payment options. You have that. You have a
interest only,
a 30-year, and a 15-year fix. So most people chose I'm going to take option 1.
Yeah,
why? Because the difference in payment from that 1% to that 4.5 interest only was at least $2,500 a month in difference.
Yeah, it was massive.
So you're like, I'll take that one. That
This
one looks
house
good.
for that much? Sign me up.
And so keeping up with the Joneses, everybody did that. It got us in a mess. And so that's what happened. So a lot of people see, even right now, even though it's being offered and we can offer it, the rates sometimes they're higher with the adjustable rate mortgage.
Yeah.
So it's like, well, I'm already put you on a 30-year fix, and we can anticipate that rates will be dropping, who knows, 8 months towards the end of the year. We're going to refinance out of it. So.
And remember, when you're doing research on all these different loan types, you're going to find a lot of things out on the internet that might be general, and that's fine. But when it comes to your specific qualification, you're going to want to make sure that with your loan officer that they're looking at your scenario through the lens of the loan program you're talking about as well, and that those things are going to jive together.
Yeah.
That they're not in conflict with one another. So keep that in mind as you're going through this process of getting approved.
That's right. And a lot of times, based on all the information we've been providing is, one of the other considerations is to shop around. Look at who has the best rates. As a matter of fact, I just talked to a client that's going to be PCSing from Italy, Naples, down to Tennessee. And so, I called him. Obviously, the realtor connected us and said he's already shopping around with USAA, Navy Fed. So I'm like, no, not a problem. So when I talked to the client, I told him, I know you're shopping around, so just give us a shot. And then as you shop, let us know what you feel. And he goes, no, I've already done business with the banks, and I understand that going with somebody who's more personable, understands the market, is probably more in my favor. So you got to understand that. And obviously, if we're the experts in the area, we understand the property tax rate in the area. We understand what the homeowner's insurance more or less estimate's going to be. And you have access to all these people because you've been conducting business in that same area. Therefore, it opens up more windows of opportunity in savings for the consumer because we understand how to leverage those resources.
Yeah. No, good point. Good point.
There's a lot more options when you work with somebody independent because of the fact that the creativity that you're able to input, opposed to a bank that needs to stay within their guidelines, within their own box of what the corporate structure is that they're running.
Yeah. No, that's good. So in the next step of, the next 10 moves to make so you can be a buyer in 2025, guys, I want to talk about paying down debt and avoiding big purchases. We unfortunately have seen this in numerous instances over the years where someone buys a car and they go, oh, I want to buy a house too. Or they go spend a bunch of money on furniture, or they take a line of credit out at Best Buy or whatever, name your favorite retailer. And then they unintentionally kind of pin themselves up against a wall when it comes to qualifying for their mortgage, and their debt to income ratios through the roof and past the threshold because they've amassed all this other consumer debt. So let's talk real quickly about, knowing what your debt to income ratio is, why it's important, and what people should be doing right now.
So your debt to income ratio is simply the money you make to opposed to the money that you pay out in debts that are on your credit. And I think it's very uncommon for somebody to understand what a debt to income ratio is if you ask them, if they're not in the financial world. Like, very rarely I see someone, no, I check it all the time. I stay on top of it. But it's actually the most important calculation when buying a house, because if you don't have the thresholds of the debt to income ratios for the certain program that you're going to, get financed through, you're not going to be able to get approved. So learning, what your debt to income ratio is based upon the loan amount or the purchase price that you want to buy, you can calculate more or less where you're at based on, how much you pay a month, what your income is, and then if you have a mortgage calculator, that could actually tell you more or less what the payment is. You can factor that into your calculation and more or less give yourself an idea of what your debt to income ratio is.
Oh, that's right. Debt to income ratios, and especially for every product, is very different. If you go with FHA, they usually, the top debt to income ratio they want you to go to is 46.99% over 56, which means 46.99% of your current income could go towards paying your house payment, which is your property taxes, your homeowner's insurance, etc. The back-end ratio, the 56, is calculating your housing payment in addition to any outstanding debts like credit card debt, whatever shows on your credit, student loans, etc. No more, no less. You have to stay within those figures. With conventional, it's pretty much 49.99% over 49.99%. And that's pushing it. We don't like seeing that. As a matter of fact, when we took our test, they want to stay within 28 to 36%. Guys, I'm telling you, that is so difficult to do. So difficult.
You got to have a crazy job.
On average, we're like 43, 46%. Yeah. VA, you can go 46 to like 56. And I'll be honest, there's been times if you have excellent credit scores, you save a good amount of money. We've approved people where they're like 69 over 79. Now, the reason why we put that person there is because not that we're trying to be irresponsible and saying like, oh, we're just going to get you approved and that's it. Who cares what happens? No. What's happening there is the wife is self-employed and they earn additional income, but on their taxes, it shows on their profit and loss, it shows them as a negative. So we're not able to use that because it hinders their situation. Because being self-employed, you get to write off, your vehicle, all you have your vacations, you get all these expenses.
There's depreciation. Yeah,
exactly. So we want to make sure that we're being responsible lenders.
Yeah, I want to make sure it's really important what you're saying, because that debt to income level is a ratio of what's allowable on paper compared to the cost that they're looking to get approved for, not actual money net at home in their budget, like we talked about in the earlier segment. So knowing your budget really tight and in and out is important, especially because the bank may look at it one way, but in your real life, it looks much, much different.
Yeah, exactly. And with VA, it's very different. It's not only just based on debt to income. There's a residual side of income that's how you really get approved, is how much income is going to be left over after you pay and you have a certain amount of kids. So you have to go certain amount of kids, see what's going to be left over for you to feed the family. Yep. So that's your residual income.
They have a utility factor inside that as well and what you're going to pay. So your monthly residual income for VA is actually what determines part of your qualification, not just the debt to income ratio itself in the VA space.
Exactly. If you don't meet the residual income, you won't get approved.
It doesn't matter. Your DTI can be really low, and if you're not meeting the residual, it's not
going to go through. So there's two portions. It gets a little more complex, but it works, okay? The best thing that I tell people to do if they want to understand what their max payment is I tell them, Andy, what I like you to do is you make $100,000, you divide that by 12, and then you multiply that by 46%. Actually, I tell them 43% because I haven't ran credit.
Yeah.
So after you divide it out of 43 cents, I'm just going to use here hypothetical numbers. That puts you like at $3,000. That's the max debt to income ratio that you're going to be able to exceed. Is 43%. Once we run credit and all that, then, and so that kind of gives them my idea is, I can search for homes. So let me log in and see when the calculator and let me see what that payment, it's under 3,000. Oh, maybe it gives me a little more boost of confidence of just going out there and getting approved.
So I want to say something super practical to everybody who might be in this segment of the show. Face the music and make a plan. List out every single credit card you have: car loan, personal loan, credit, store credit card. Face the music of what you are in situation wise with your money and what debt is holding you back from maybe crossing the threshold of getting approved for a home. These things will come up on your credit report, and we talked about credit at length at the beginning of this show. So you have to be honest with it because you're going to end up having to be honest with us. We're required to be honest with underwriting. Underwriting's required to be honest with the end investor. And ultimately, for a deal to happen, these things are going to have to be addressed.
Yeah, and one of the biggest issues we've been seeing is a lot of our clients, and I've heard these horror stories, is avoid big purchases. So as you're going and you're already in the home, a lot of times you go back to the property, you drive around, and you're already visualizing yourself there. So what is it that you need? I'm going to need furniture. I'm going to need a new stove, a new refrigerator, a new washer and dryer, right? Because a lot of those things don't convey with your purchase. So they're already asking you, can I go run my credit? They're offering 0% down at Best Buy right now. And it's like,
don't do it.
No, don't do it. And then when can I do it?
Right when
We're going to sign loan documents tomorrow. Can I do it now? No,
Nope.
Don't do it. What we're starting to see, Andy, is at the last minute, the investors pulling credit. They're doing a soft pull. It doesn't hinder anybody, but they get to see the inquiries.
They're trying to see if you added debt since they approved you.
Absolutely.
Yeah.
And we did have one 3 months ago where it was a $29,000 debt. $29,000 debt. We had already signed loan documents. They ran that credit. And mind you, most of the times we table fund, so we'll fund that same day. So somebody caught it that. And we had to unwind that and identify what that debt was.
Wow.
And so we identified that, one, she has enough funds to put that for that debt so she can pay that off. Secondly, her income was so high that, even with the monthly payment, of what was it, like $500, she was able to qualify. But most don't have that luxury.
Yeah. Yeah, no, that's important. Back when I was doing sales, I used to tell people, would you rather have a garage you could put a car in or a car you have to find a garage for? And that was really just a qualifier of like, hey, listen, how important is that to you to put one in front of the other? Like, get the house first, go get the car later.
Yeah.
Guys, let's talk really quickly about this next one. This is gathering key financial documents. This is more of a procedural aspect for me. But look, this is really important because how many times do we have people who might, in their mind or their heart, they are just so gung-ho to buy a house, get qualified, and they don't have their stuff ready.
And they give you your documents like 3 months later, but they're asking for the approval every day.
Or they don't know. I don't know where it is or whatever. So listen, I know we beat everyone over the head with this. Like, be proactive by being organized, know where your documents are, and have them at your fingertips. It's very easy to do if you will just stop long enough to focus and put yourself in good order. That's going to give you the best chance of getting qualified.
So I'm going to be honest. Sometimes I'm not the best at being the most organized and, keeping everything in, the same place. But if you ask me, I know where it's at. So what I would suggest is that if you're in the process of buying a house, you're not the most organized, you're not the most, best at keeping track of things, you always have your phone on you. Find a document, add all these documents that you can access through your phone and put them in a folder on your phone, because the phone is the one thing that everybody carries everywhere and is on them at all times. So we nowadays have social media on our phones, emails, able to log into our able to pay, basically able to do everything through our phone. So if you have a phone, there shouldn't be really an excuse besides the lack of you actually wanting to take the action to go and store those documents and actually pick them up, organize them. It takes 10 minutes, maybe 20 if you're unorganized like me, but just get it done.
Yeah. Now, one of the things, if you're a W-2 wage earner and you don't own a home, the list is very simple. It's going to be a pay stub, last 2 years of W-2s, copy of your ID. A lot of times now, Social Security's been being requested just because Social Security wants to identify that you are the one that's doing it. Bank account statement, and we've been asking for even retirement. The reason for we ask for the retirement, because then it looks like reserves. It looks like the higher you have reserves, not that we're going to use that income for down payment or anything, it just makes you look a lot better on paper.
And what about tax returns, guys? Like, what's the rule of thumb for that?
So the rule of thumb with tax returns, anytime you're self-employed, or you're W-2'd, but you own several properties, you have what's called a Schedule E, and there you put all the information where you deduct the mortgage insurance, the property tax, et cetera, and that's what we'll need them for. For instance, the person that I spoke about earlier that's in Italy, in Naples, he owns a property already in Washington, and he's been claiming rent since 2016. So therefore, I'm going to request the tax returns, because what I don't want to do is when we request what's called a 4506 transcript, that information can come up and now we didn't disclose properly, and we just don't want to do that. Or when we run credit, we get to see another mortgage in there, and now we have to identify, well, who's renting this property, who's in it, and now we have to really be able to figure out who's paying for that. And so the taxes will tell us that information.
I'm glad you brought up the 4506T, because some people don't know what that is. So it's basically a form that you send to the IRS, or the IRS sends back to you. It's a tax transcript, and the underwriter is looking to make sure that matches the tax returns that you've supplied us in the process of your approval. They need to make sure that matches. There are times when it does not match, and there's an error on the IRS side, or there was an error that was mistakenly made on the tax side, and you need to do an amendment or things like that. But again, this is why we say be prepared, be proactive, get organized. If this comes up and you're already in escrow or you're in the process of getting approved, this is going to be something that delays your process and possibly threatens the deal closing, simply because we just didn't operate in an orderly fashion.
Yeah, that's correct.
Yeah. Brian, any thoughts about gathering other documents? The phone was a great suggestion, by the way.
You have it on
No?
your phone.
Okay, cool. Okay, so Memo, let's talk really quickly about something that we, really advocate for people is get a great real estate agent. Look, there's a lot of people that are agents. There's a lot of people with a variety of experience and track record, but let's talk about real quick some of the advantages of having an agent who works with the specific loan type you have or you're approved for, the area you're looking for, or just temperament, if you will.
Yeah. I was smiling when you were saying that, just because you're, the way you're saying, and it's like, we have a lot of clients that are actually represented by new friends that just got their license. And we know in this market right now, Andy, it's about understanding your market, being in the true trenches, understanding how to negotiate. Because it's not about just negotiating a purchase price when you're getting into the property. It's all about the afterwards. What happens when you do your home inspection now? And the inspector identifies, hey, there's leaks. The water, the ceiling looks like there's water, right? And things like that of that source. You want to have a strong negotiator with you, not just somebody that's looking at it like, I just started my career. I don't have income that's coming in right now. So therefore, now this becomes my paycheck, and now I'm worried about if I'm going to get paid or not. Versus the one that has multiple transaction is not looking at you as a transactional driven, client.
Yeah,
so very important.
And something I want to say here too, and this is something I've seen over the course of time, be a good client too. It's one thing for us to talk about agents, but, agents can do their best work when you're working together with them. If you're providing resistance, if you're being vague, if you're being dodgy, if you're being unclear, that will not help you. That will actually set you further back, even when you have a good agent who's been in the business for 10 years, 15 or 20 years. And let me say this, I'll say this in defense of some of our realtors, they don't have to take you on as a client. Just remember that. They don't have to take you as a client. Someone else can deal with you if you're going to have a bad attitude about that stuff.
That's a great point, Andy. How much money does it cost a client to hire a buyer's agent?
Well, it depends. It could be 2%, 3%.
It can. That's what the new rule that was passed last year, correct?
Oh, but you're talking about it's not going to cost you anything out of pocket. It's going to be zero because the seller's going to pay it.
Exactly, because a good agent's going to negotiate their own closing cost.
Yeah.
And so those are things now to factor in. The life of a realtor representing a buyer has really changed. A buyer buying a home now has really changed. Things are different now. Now you have to worry about, not only do I pay a down payment, I pay closing costs. Now I have my realtor I have to pay. So now you have to hire the right realtor to negotiate their own representation.
Mm-hmm.
You know, and I've seen it where agents, we just got an offer in and they were going to pay 3%, but because they're giving the client closing costs, they negotiated 2%. And now the agent went like, wait. That ain't going to happen. I want still the 3% and still want the closing costs. And so they were going on the back and forth, and they have to figure out if this is just the bluff on the listing side, or and the listing agent has to see, are they just bluffing on the buyer side? That's where you got good, strong negotiations. So there's a lot of stuff that goes in there.
There's a little acronym. I don't share this with everybody, but with people I talk to that ask me for advice, I have a little acronym I started using called FPP. It's
Do
familiarity.
you know me?
No, not OPP. It's FPP. It's familiarity, proximity, and professional record. So how familiar are they with the area you're looking to go purchase in, down to the neighborhood in some cases, and the type of financing you're doing, that kind of thing. The proximity, what's going on around? Like, what's that traffic pattern like? What's actually happening around that area and that zip code that maybe you don't know about because you're moving to a place that's outside of where you live now? So what's coming up? Is there new traffic laws coming up? Are there new buildings going in? Is there going to be congestion? Like, what are that kind of stuff? And then their professional record. What have they done that you can trust that they will make its way into your transaction as well and help you succeed in closing?
No, absolutely, Andy. A lot of people don't understand where to look for this information. So one of the web pages, what I found out, you can go, and again, we'll put this on the screen. It's www.homes.com. You put the realtor that's representing you, and it'll tell you what their sales have been in the last year, 2 years, and 5 years. That is great information for you to go in there and look and see, is this the person that I feel confident is going to represent me in the way that I want to be represented? In addition to that, you could always go and just Google, Google reviews.
Yeah.
That's another great indicator. A lot of people don't understand. People will pour their heart out when they get great representation. They'll put it out there. And when they're getting horrendous, assistance, they'll make sure to put that in there. The in between, you don't see them putting as much in those reviews, you know?
Yeah. So, and actually, what I'd like to do, especially for our mobile viewers, I'll put the link in the description so they can just click on it.
Perfect.
Yeah. So, thank you for bringing that up. That's a great way to kind of take a sneak peek, if you will, at your agent, and then, just ask them all the questions you want to ask. Your agent is going to be willing to help you because they've committed professionally to help people buy and sell homes.
Yeah.
So, just remember that. That's going to be the priority.
Yeah. Most important thing is, have you seen any of the buyers that you represent that they pay their own commission? If they say, oh, most of them do, you may want to look for another one because you just don't want to be caught again with down payment, closing costs, and paying for your realtor.
Yeah. Well, and the next thing here, this is the 9th on our 10 things or 10 next moves to be a successful buyer in 2025 is be strategic with your home search. Now, this might sound really simple on the surface, like, yeah, duh, why would I be general about my home search? But look, you're making a big commitment. It's usually people's largest purchase, the biggest debt they're ever going to get into, their largest monthly payment they're going to have. And sometimes you have to make concessions. Like, oh, I might have to drive a little bit further than I want to have the right place I want. But know what you want. Know if it's the neighborhood that's more important than the quality of the house, cool, pick the neighborhood. If the quality of the house is important and it's not a neighborhood you want, fine. Get the newer home and not the one that needs some touch-up work or whatever. But understand those things going in so that when you're confronted with maybe some options, you can make a qualified choice for yourself.
Excellent advice. Excellent advice. And totally. Here's the thing, though. I'm sure you purchased a brand new car in the past. And I'm sure you thought it had all the bells and whistles. And once you drove it off the lot, another friend had the similar car, but he ended up paying a little more for the details. And you're like, dang it, if I could only go back and I would add this. It happens also with homes. One of the things I tell when people are already getting into escrow and they're doing a home inspection, I tell them, don't go in there and chatter with your agent. On the contrary, wherever the inspector's going, you're kind of going to the opposite way to familiarize yourself. What are the stuff that they're looking in this home inspection? Obviously, if they're getting under, if it's a raised foundation, you're not going under the foundation with them, but at least now you understand they're going in there. That gives you the opportunity to go, even go to the bathroom, your master bathroom, and sit on the toilet and just kind of feel yourself being there, right? As corny as it sounds, but now you're seeing things differently. You're going to the kitchen sink and you're pretending to wash dishes. You're visualizing yourself there. And then you turn back and say, is this where I'm going to spend Thanksgiving? Like, you got to really put yourself there. And I can't tell you how much that works with past clients that have done it. They're like, Will, thank you for telling me that advice, because after I did that, I didn't feel comfortable with that purchase, and I had to find something else.
You know, I'm so glad you mentioned that, because I think this is one of those like face the music kind of things I had mentioned earlier when it came to like your debt. Is face the music, like be real with yourself and with your family about what are your non-negotiables and your negotiables.
Yeah.
If it's we have to have a 3-bedroom house and a 4-bedroom, whatever it is, be firm about that. That's fine, but then be flexible in the things that you're willing to compensate for in order to acquire home ownership. Not everything is a die on the hill moment when it comes to buying a house, but to your point, it's really important to kind of understand, what will your life look like when I'm there?
Correct.
What's it look like leaving the neighborhood and coming back? When I'm leaving the neighborhood, am I thinking, man, I can't wait to come back here? Or when you leave the neighborhood, you're thinking, man, I'm glad I'm leaving this neighborhood. Like, that tells you something. Like, have an honest moment with yourself, and if you're married, with your spouse, and determine, hey, is this place really for us or not? Can we envision ourselves here for longer than 3, 5, 7 years, whatever that time frame is? Have these conversations proactively, so you know when you're walking into a place, you go, oh, that's my place.
No,
That's
it's
the
so
one I was
true.
looking for.
It's so true. I mean, one of my properties, I loved it. It was one of my favorite houses, the 934 Stonegate. One of the deteriorating factors of why I wanted to deterring factors why I wanted to move out was because when I would drive in, if cars were parked in the side, right, in that person's side of the street and mine over here, it was too hard to get 2 cars through there. The street wasn't feel wide enough. So I was like, this is ridiculous, you know? And so that was one of the deterring factors of why I said, we got to move out of here. You know, I want to go somewhere where it just felt like the street was wider. You know, I didn't have to worry about like, oh no, let me close to the side and you come through.
Right.
I mean, as silly as it sounds,
Taking turns.
as silly as it sounds, but I mean,
Yeah.
now I'm very happy where I'm at in the cul-de-sac. I don't have a neighbor to my right. I only have a neighbor to the in back of me, and I have a slope, so I don't even get to see that. And to the left of me, right to me is a park, and it's great. It works out great. I love it.
Yeah.
So-
No, that's good. I think identifying the must-haves and the things they're non-negotiable, and the ones you're flexible with are really important. And really, in the excitement of looking at homes and the excitement of the prospect for buying a house, it's easy to kind of get like horse blinders,
Yeah.
and you don't see all the other stuff going on. But like, I guess this is my last point, and my advocacy here is like, be aware and alert of the situation you're in. Look at stuff, like slow down and take a look around. Pause and listen. What sounds do you hear? Is there a helicopter going over every 10 seconds? Is there a dog barking next door? You know, whatever it might be. But just, take a minute and really take inventory of what's happening around you in that place that you're looking at.
Yeah, and this is first time home buyers, in summer of 2025. Another thing to consider, Andy, is we have more choices. A year ago, we were only at 400 some thousand homes available nationwide. Right now, currently, last week, we're at 796,000. So that actually, they're seeing more inventory. And now that we're in the summer, there will be more inventory. So just because your offer was accepted, I always consider keep yourself on the search list, because you never know when you do your home inspection, you may find flaws that you didn't think you saw when you first walked through it. Because we remember we're walking, we get excited. It's just emotions are going. You see, oh, this could be the baby's room, and so you kind of lose track of sight with that. But then there's another home that pops up in the same area with more upgrades or a larger garage. Then there's more that you can do. You're like, well, wait a minute, I can get that one $5,000 less. And the home inspection didn't work out over here because I had it. Let's put an offer and let's see how that looks, right? Or also keep in mind that there's an appraisal that needs to be conducted. And if the value comes in low, now you have to go back to negotiation, where maybe just keep your options open. So important.
Yeah.
This is the biggest purchase you're going to make in your life. And us as a lender, since we're getting you into the biggest debt of your life, one, we want you to be happy with your choice, sincerely. And we want you to just be happy that, okay, I'm going to make this payment because it takes a lot of sacrifice to do, and that doesn't go unnoticed. Just, we want to make sure that this is the one.
Yeah. No, great point. And kind of a good segue into the final thing here on our 10 best moves to make if you're a buyer in 2025 is don't skip your inspection and appraisal. But connected to this, I want to talk about the contingency connected to that as well. It's not just should you do an appraisal or not. Well, depending on the loan type, you're going to need one. It's required.
It's required.
And the inspection you're going to want, whether it's required or not. But let's talk about the contingency aspect of that on the contract side, and then let's talk about inspection and appraisal. Yeah.
Yeah. So every inspection, so there's a home inspection that is actually that's up to the buyer. It's not mandatory, but we always say, if you're going to purchase anything, even when you're purchasing a vehicle, you want to take your mechanic with you to see if there's any problems with the engine, or if there's any water in the oil. Like, you want to check these things. You want to know that you're buying a good vehicle. In this case, again, this is one of the biggest purchases you're going to make in your life. You owe it to yourself and your family to make sure that you're getting a full home inspection. Again, there's friends, there's people that are recommended. If your realtor recommends and you're getting a top agent, they're going to recommend this home inspection and refer you to somebody who they've been working with that's, proven a track record, because you also want that to be a good proven track record. There is times when you hire a home inspector and then a month later you go in, there were water leaks that he didn't notice or that were created. So there's some home inspectors that have this actual insurance policy that covers that from them. Because you're going to be upset. Like, well, what happened? Why don't you know? We just did that. And we've seen this happen many, many times.
Yeah.
So always good to have a home inspector and then ask them words like, what got you? How many years have you been home inspecting? Do you have a general contractor's license? Even though it's not a requirement, it's always good to see if they have any idea of what that may be or consist of. Because there's a lot of times with these, people that were home general contractors actually turn to be home inspectors.
Yeah, and there's something I wanted to, and this might be a practical note, and this may seem elementary and obvious to you, but take a notepad and a pen with you. And if there's questions you have, ask your questions or notate things. Ask about lifespan. Hey, in this house, it's already 30 years old. When have you seen the pipes need to be replaced? How long do you think the roof still has on it in years? What would you say about how long this crack in the driveway is going to last, or whatever it might be? But ask those things. Again, this is part of my whole, be observant, take note of what's going on around you, be aware, and ask. It's okay to ask, and it's okay to get their industry advice as well. Again, if they're formerly a general contractor and they're an inspector now, they've seen a lot. And they can tell you a lot about the materials that were used, the craftsmanship and the workmanlike fashion things were done in or not. And they can give you some insight as to what might be facing you in your homeownership experience.
Another cool home inspection that isn't something the home inspector does is they don't check like your actual pipes, where they actually put this camera and they look at everything. That is, I highly recommend, especially on an existing home, highly recommend that.
Yeah.
So that way you can really be clear, how the water pipes are.
Yeah, sometimes you'll find root systems that are growing through certain pipes, and it may not be disrupting the water flow, or you might not see dirt coming into it, but those cameras in there, man, they can find stuff.
Yeah, not yet.
Well, that's what I'm saying. It's not yet then. It kind of goes to that like lifespan part of like, hey, ask what the lifespan of that stuff is and find out. And on the appraisal side, really, I think this is just more, it's part procedural and it's part safeguard. If you're going to end up buying a house and it is the most expensive thing you ever purchased and your biggest monthly payment, well, you want to know that it's worth what you're paying, right?
Yeah, correct.
So don't be trying to cut corners on that. And please do not remove your appraisal contingency if you're in escrow. I know that some people might say, well, I want to make my offer stronger. Okay, if you're in a position where you can afford to lose your earnest money deposit and you have a little more money down and your closing costs saved up and whatever, maybe there's a situation where you can convince one of us that that'd be okay. But in most cases, that's usually not a rule of thumb for people.
Yeah. And I really think, Andy, we've seen the last of that for a while.
Yeah.
Being that there's a lot more, supply of homes available, I don't think we're going to be seeing a lot of that. Homes are, taking longer to sell nowadays. And again, because of a whole affordability factor, higher interest rates, higher purchase prices, we're not seeing that, as often as we would before. I mean, times have really changed, and they've changed for the buyers. In the buyer's favor.
Yeah.
So I take advantage of it right now.
And I only mentioned it because, it wasn't too long ago that people were offering 25,000 more, 50,000 more, 100,000 more. Like, hey, forget the appraisal. It doesn't matter to me. I want this house more than the 100 people in line I'm, bidding against.
Yeah.
So.
I mean, it still happens, it still happens, but very rare are we hearing that.
Yeah.
The appraisal is very important because remember, the investor is going to be loaning you the money. So if the investor wants to know, if I'm going to loan you 800,000, we need the value to come in there. We understand that you're going to be putting money down, or you're not with your VA, they still want to make sure that they're investing in the proper investment instrument, which
Yeah.
is that property.
Yeah,
So
absolutely.
that's a layer of protection for the lender and for the buyer. So if the value, let's just say they're buying for 800,000, the value comes in at 780. Again, I know we talked about this earlier about the realtor having a strong negotiator. This is where your realtor is going to go and renegotiate the terms and conditions again. You know, hey, purchase price to be 780. And a lot of times the listing agent is going to try to get you to fill in that gap. Well, no, we'll go to 790. And you're going to say, no, 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 no. I either, I'll walk out. And the good thing is your earnest money deposit would not have been lost at that point. I'm hoping that the realtor kept those. A good realtor would. The only thing you'll lose out is any home inspections.
And can I talk about that real quick, because that sways the let's say that puts the pressure back on the seller side of the
Correct.
table. You know, that seller has to decide, well, that's just that appraisal. Well, okay, if that listing agent disagrees with the appraiser, they have to rebuttal that. And
Correct.
they have to come up with evidence that they think is stronger than the comparables that the appraiser has already used in their appraisal report, which in most cases is an uphill climb. So number one.
Yes.
Number two, on the buyer side, and you and your buyer's agent can be like, look, it says 780. If we back out on this because our EMD is secure, we haven't removed our contingency for our appraisal, then good luck to you, because the next guy's going to come in and that appraisal is probably going to come in at 780, because if your house is going to go back on the market right away, guess what? Those most recent comps that were just used in the one that I'm backing out of are most likely to show up in the next appraisal too.
Correct.
Or in the case of VA, the appraisal stays with the property, and that is the appraisal for the next buyer.
That's it.
So just remember some of those little nuances too.
Exactly. So all these are just extra layers of protection for just the consumer and the lender. And we're going to make sure that we look at all these, we factor all this information in. In addition to that, obviously, the loan, as a lender, we want to make sure that you're also not removing those contingencies, and we keep you, we keep these safeguards in place for you.
Yeah. Now, one of the things I just, in kind of wrapping this up, is I know that we kind of brought our top 10 moves you can make to be a qualified buyer in the summer 2025. But, really, these are kind of generalities for anyone who wants to buy, whether you're a first-time home buyer or not. It might be that you haven't bought a house in the last 7 years or 10 years or 15 years. The market's changed. The banking has changed. The appraisals, and just everything is a little bit different. It may not be a lot different, but it's a little bit different. Different enough that it's worth taking note. So if you find yourself in a position where you're looking to buy, even if you already own a home, come talk to Will, come talk to Brian, ask us a question, put a comment below, DM us on the socials, and let us know what it is you have a question about so we can help you. And as I'm hoping you expect, there's a lot of other factors in buying a home that we talk about. But I wanted to just really kind of offer up the things that are most common that people here are talking about that we don't always talk to the cameras about.
Correct.
This is happening at your desk. This is happening with people on the phone. This is happening on Zoom. These are all the things that people are asking us about.
Well, that's why we chose these topics, right? Because these are the most important ones to talk. There is 10 of them. That pretty much covers most of it. And I kind of grinned a little bit when you're saying things have changed a little. I think things have changed a lot. There's a lot of
little
differences.
facetious.
I know. Considering that interest rates are pretty high. I know they're not historically the highest, but they're high enough. And the reason why it makes such a difference is because our purchase prices, now our average we see is $417,000. Where before we were seeing these things being 100-some thousand, then 200, and we're like, whoa, where's this going? But we're here in San Diego now. Your average is $980,000.
It's insane.
That's for a starter home.
Yeah.
For a starter home.
Well, we did a whole segment about $1 million starter homes in 28 states.
Correct.
So 28 states have a city where the starter home median price is $1 million
It's
or
$1 million.
more. That's insane. And so when that's the situation, it's even more important that you follow all these things we're talking about, because it does feel like there's a lot more on the line, not just mathematically, but I mean, this is a big chunk for a lot of people.
And that's why this is so important. These top 10 things are very important to understand, about who you hire, who you think is going to have the best intentions in mind for you. Like, it's so powerful to know and feel confident that you have the proper lender. And it doesn't matter. It doesn't have to be us here. There's plenty of great lenders out there that you can, use. Make sure you're just asking the proper questions. Make sure that this information that we provided you gives you some insight as to, what do I ask now? How do I ask for this? And then how can, I figure out how to really get the proper lender, get the proper realtor to represent us. This is a family thing, right? This is for your family. This is the home that you're going to get into. So important for all that.
Well, I wanted to thank you and also thank Brian, who we had to release a little bit early today. But thank you, Will. Thank you, Brian, for both going over all this today. And thank you all for watching. Remember to like the video, subscribe to the channel, turn on that notification bell so you catch every episode every time we release it. And if something we talked about here struck a chord with you in one of the 10 chapters we talked about today, let us know how we can help you. And if someone you know, love, and trust has said something that's related to one of the topics that we talked about today, make sure you forward this to a friend or a loved one to help them in their pursuit of homeownership in 2025.
That's it.
Yeah. So thank you for another great episode today, Will. Brian, and myself will catch you next week. See you later. Bye.
See ya.
So if you enjoyed this video and got value from it, subscribe right here. And if you want to watch another video, click right here.